Hey everyone, this is Hunter Satterfield, the Chief Investment Officer and a partner here at Kane Waters and Associates. As always, I am joined by one of my fellow partners, Brian Bortz. He is also the head of our investment committee, and then also Brad Sanders from Tectonic Advisors. And this is your May monthly update. For the month of May, the S&P 500 was up 0.2%. Global stocks were up 0.1%. Domestic bonds are up 0.6%. And then global bonds were up 0.3%. So overall, what appears to be a relatively flat month, but as I'm sure we're going to hear from our guests, may not necessarily have been that way intra-month. So I want to flip it up a little bit and actually come over to you to start, Brian. You and I both working with clients. I know we're starting to hear some concerns around sort of that dreaded R word of a recession, a potential recession. It's things that we're hearing in the news and our clients are hearing in the news. Can you talk a little bit about what you're seeing on the as the head of our investment committee, and then what types of things you're communicating with clients on?
Yeah, thanks, Hunter. I appreciate it. I actually have been getting a lot more phone calls, texts, emails from clients, just wondering what our thoughts were and wondering if we should be doing something different or not. And actually been getting a lot of communications from our staff as well. So I sent out a note to our staff, and the title of it was Perspective. And there was an attachment. Anyone who's interested, if you want to go just Google search what the 20-year S&P chart looks like, that's going to give you some perspective. But really what I told our clients and what I've told our staff is that the last recession that we had was in 2008. What happened in 2020 wasn't really a recession. It was a turning on and off of the economy. But we had a real recession in 2008, but that was 14 years ago. And typically we have recessions on average about every 7 years. And so 14 years ago, some of our staff and a lot of our clients were literally still in school. So this is something that's new to a lot of people that have not experienced this yet, and just gave the perspective of the fact that for the last almost 2 decades, we've been in almost a 0% interest rate environment with a very friendly Fed monetary policy, with no inflation, a growing economy, pretty much every perfect ingredient you could want economically speaking. And so a lot of people just aren't used to hearing bad news. And so I wanted to give some perspective that the sky's not falling, that we absolutely know what to do in a period of time like this. And we've already positioned ourselves to do well. So that was really the message, was perspective.
Yeah, that's great. And it is definitely something that we need. And I'd actually love to flip over, Brad, to you and to get a little bit of your perspective and what you as the managing director of Tectonic Advisors and your team, what types of things are you guys seeing, especially in a month like May that appears on the surface to be a flat month, but I know there was quite a bit of volatility, intra-month. What types of things are you guys seeing here as we go through the summer into the second half of the year?
Yeah, May sure was volatile. I mean, as late as May 20th, the S&P 500 was down 5.5% for the month, and we ended up. So, I mean, it made up all that ground in a handful of trading days, really, when you back out the holiday and the weekends. And I think we actually texted sometime around mid-month, and I said to you and Paul Lyons, shout out to Paul, that it wouldn't shock me if we got a rip in the market because it was just so oversold in the short term. And I think that's what we're seeing right now is I think everything you look at is trying to predict what the Fed's going to do with rates and what does that mean, and is the Fed going to ease, and everybody's so hyper focused on that. And at Tectonic, we've kind of turned our attention to the consumer. If you've seen some, I'm sure a lot of people watching this have seen the moves of some of the big retail stocks lately. Target, most notably, lost almost 40% of its market cap in 2 days after their earnings announcements. And across the retail space, you're seeing inventory builds, lower ticket per ticket spending per consumer, and consumers are going into those stores and buying food and basic necessities and none of the big ticket items. And what that tells you, combined with the consumer credit numbers, which we've mentioned on here before the last couple months, is that the consumer is starting to struggle. High gas prices, those are going on credit cards, tanks of gas. The average consumer doesn't have as much in savings as our clients. So when we start talking about consumers, we all try to relate our own, current situation, and that for most of our clients, it's quite different than the average American. The average American, I think it's a lot worse than what's being portrayed in data so far. And to Brian's point, 72% of GDP annually is consumer spending based. We're very much a service and spending based economy. So when you start dinging the consumer, you triple the price of gas. You have food costs going up. You have inflation like this. It doesn't take very long, and we've already seen that. So I think a recession is kind of baked, to Brian's point, at this point. But it's not, 2008. We shouldn't overlay 2008 for our clients that were around during that. And I was managing money. Such a different situation than we're in now. We should be expecting a recession of the mild variety, a couple quarters of negative GDP growth, turn that around and start growing again, 18 to 24 months later, something like that, is kind of what we're thinking at this point. And, that's something that you can manage through, and you can actually end up investing money and making some really good investments during those kind of periods. We shouldn't really be looking at 2008 as the barometer. That was more of a 100-year event than it is every 15 to 20-year event.
Yeah, it's great info, guys. And I think that, again, it sort of, as we come out of a 5-month stretch where we see the overall market, both in the stock and bond fixed income markets, continue to be, sort of a tough one. And we probably have, to Brad's point, a little bit of continued volatility to come. But again, it's about that perspective, Brian, that you mentioned, which is really helpful. So as always, thank you for joining us, and Brad and the team at Tectonic, and Brian and the rest of us at the investment committee. We'll continue to be focused on this, and we will be back in front of you at the end of June. Thank you so much.